So to my left is Oren Cass. Oren is the founder of American Compass and the director of American Compass, which is a Washington-based policy shop focused on charting a new path forward for worker-oriented conservative economic policy. And over to his left is Allison Schrager, who is a senior fellow at the Manhattan Institute. She's an economist who writes regularly about macroeconomic policy, and she is a columnist at Bloomberg and a regular contributor to City Journal. And finally, we have Kevin Hassett. Kevin was the chair of President Trump's Council of Economic Advisors, and since leaving the administration, he's a distinguished fellow at the Hoover Institute at Stanford University and the managing director of the Milken Institute. So I'd like everyone to join me in a round of applause in welcoming our guests. And with that, I'll turn it over to you, Oren.
There we go. Well, thank you very much. Certainly everyone who's organized this. This has been an incredible conference, and the sort of thing my sense is that the university doesn't put its shoulder all that hard into making happen. So congratulations to all of you. It's a real pleasure to be here. As Trevor said, at American Compass, we work primarily on trying to rethink what conservative economic policy should be. To an extent, I would argue to restore conservative economic policy to what it was from the American founding through roughly the late 1970s when we had the so-called Reagan Revolution. And so I brought a few slides that I want to use to sort of underscore what I see as the problem today, and then we can talk about where to go from here. So if we skip forward one, this is the problem. It's what I call the curse of voodoo economics. Voodoo economics, of course, is the term that George H.W. Bush used to criticize Ronald Reagan's economic policy in 1980, and specifically the argument that just cutting taxes would sort of pay for itself and unleash the economic growth that we needed. It's really important to understand that was a new idea at the time. There's nothing inherently conservative about an agenda of tax cuts, and more tax cuts. You will not find it anywhere in Edmund Burke. You will not all that much find it in Ronald Reagan, who after his 1981 tax cut proceeded to raise taxes 5 times when he realized that in fact it did not pay for itself. But somehow since then we've been under this illusion that economic growth is simply a function of getting the tax rate down lower, and tax cuts have been the leading edge of what our economic policy has been, even when you had Donald Trump come in, who you would think was going to represent a very different approach, and then didn't. He passed TICJA. And we have the Tax Cuts and Jobs Act. And we have these debates, did it work, did it not work? And so I wanted to provide my view of why it did not. I should say these slides are about Kevin. They're not intended to be specifically about him. I think this captures very well the way the conservative establishment thinks about this, though I'm delighted to be able to tweak Kevin and also give him a chance to respond. But this is the presentation that Kevin, in his role as chair of the Council of Economic Advisors, gave to the American Economic Association's meeting at the beginning of 2019. They were about a year into the tax cuts and trumpeting their success. And I apologize, I can't see the chart all that well, so I'm going to look at it on my phone, which is terrible form, but there we are. And so the first data point we looked at was this statistic called contribution of private non-residential investment to GDP growth. And what it showed here, based on data toward the end of 2018, was that we had seen a significant jump up in the year after the tax cuts. And as Kevin put it, did they work the way that we anticipated? Then yes, you'd have to say, well, yeah, because we have the ex-ante evidence of what the proposed effect was going to be. And if you look at what actually happened, it came in right about there. So you can see in the year after the tax cuts, right at the top end of those lines of what the economic models estimated. If we skip forward, I also, there's always a question, okay, but is it the tax cuts or is it everything else that's going on? Is it really fair to assess tax cuts this way? The argument that, again, I think you would hear from most conservative economics is the tax shock in the year after a big tax reform is so big relative to everything else that historically has happened that the ceteris paribus assumption must be about reasonable, because otherwise we wouldn't keep getting the same answer. But if we skip forward, there is always a risk of using preliminary data midway through a year, which is that the Bureau of Economic Analysis goes back and revises it. And if we skip forward again, we'll see what the actual final result was. It turned out the prior year was a little bit higher than had been estimated, and that year, especially when you took into account the fourth quarter, showed essentially no effect on investment. If you skip forward one more, this is that data just translated into my chart format to show on the right side that you see, so blue side is what you had available at the time, red side is what actually ended up being the case. In fact, if you looked over the 2 years post-tax cut, you actually saw a significant decline in this measure. Next slide. Got to do one more, got to look at growth overall, which is the topic of this panel. You saw a series of models that said a big tax cut was going to give you a big bump to growth. And again, in speaking about this, the headline thing that we model with real science, if you say the tax cuts aren't working, then you're kind of in some kind of denial that you should think about. Or you should show me some evidence and test my understanding because maybe there's something I'm missing. I will accept this invitation and skip to the next slide. One more. Those are actually down arrows. In fact, growth in 2018 when the final data was in was lower than it had been in the prior year or in the business cycle to that point. You can skip ahead. There's the preliminary data on the left, the final data on the right. And if you skip ahead one more, it's important to say this is the exact same thing that happened with the Bush tax cuts. Pick your pre-post time frame, look at on the left side business investment, look at on the right side GDP growth. It is essentially impossible to make out an actual positive impact from the Bush tax cuts. And if we skip ahead one more, there's a very good paper that Gale and Samwick wrote for the Brookings Institution in 2016. In particular, Samwick was the Bush administration's chief economist shortly after the tax cuts had passed. And what they essentially say is, a variety of forms of evidence suggest the impact of the Bush tax cuts was negligible. Then skipping down to the bottom, no first-order evidence in the aggregate data that these tax cuts generated growth. Careful microeconomic analyses give similar conclusions. And skipping one more time, by no means obvious on an ex-ante basis that tax rate cuts will ultimately lead to a larger economy in the long run. Now, this is my final slide. Let's leave this one up. The question we should be asking is, where's the growth? Right? We have embarked upon this project that had a particular philosophy about what we needed to do to the economy to generate the kind of growth that we wanted. Reagan dramatically tried to pursue these tax cuts. Obviously, we know all the deregulation of the late 70s. I imagine it would surprise people to know that GDP growth in the 80s was actually lower than it had been in the 70s. We obviously then pursued globalization. That doesn't seem to have helped. Post-2000, we saw the 2 slowest decades of growth on record, again, as we continued to pursue efforts to, among other things, lower marginal taxes. And I think what's so important to say about this is that it simply need not be the case that a policy that would make sense in 1980, when marginal tax rates were in the 70s, they were 40 to 50% on capital, would still make sense when those rates are half of that level. And I should say also that this isn't necessarily a fair way to look at it. There are obviously many much more refined analyses that you can do. Incentives do matter at the margin. Presumably giving tax cuts to certain groups of corporations will lead those to invest relatively more. But it is our responsibility to zoom out and ask, is this working? And I think it is our responsibility to look at that data and admit that no, it is not. And so if we're conservative then, rather than stick to the dogmatic ideology that, well, tax cuts are good and so we should do more tax cuts, I think we should go back and ask, well, where does economic growth actually come from? One interesting thing about economics is that we don't really know. But I think we can have a point of view on what those key things are. And I thought this was something Peter Thiel also addressed very well, which was the idea that, at the end of the day, the question is what is going to get people out there taking risks, investing, and so forth. And if we have an economy where the most attractive things to do and the best ways to earn a lot of money or generate a lot of profit are things that do not lead to significant domestic investment, that do not promote innovation, that do not create good opportunities for the mass of people who are not the entrepreneurs and capital investors, then at the end of the day, we will not get the growth, and tax cuts aren't going to address that. And so the types of policies that I think need to be at the heart of a conservative agenda for reigniting economic growth are twofold. One is in the category of what I would call productive markets, which, as it implies, emphasizes that markets are not necessarily productive. We need to recognize that maximizing your profit by offshoring capacity and ultimately the expertise and ultimately the IP with it is not a recipe for greater productivity at home, even as it does maximize the profits of those making the decisions. We need to recognize the same thing about encouraging those of you in this room to go into hedge funds, trade monies around in circles, making no actual investments in the real economy. That is undoubtedly a way that you can make a lot of money. That doesn't mean it's productive. We need to think about actually specifically rewarding domestic investment, making it attractive to pursue the kinds of hard investments in building things in this country. I think we need to look at competition policy and recognize that we are, particularly in technology, in a venture capital model that says the whole point is monopoly. That is, that's what Peter's book is about. And in an economy where dump venture capital money into securing a monopoly in some sort of app is the preferred strategy, you shouldn't expect to see very good economic performance. The other side is supportive communities. This is where conservatives are generally more comfortable, though we've refused to acknowledge the role that public policy has to play in this. If we think about an education system that does essentially nothing for the majority of people who are not going to benefit from a college education, we actually need to build pathways for those people into the workforce and actually support employers in providing them with their initial jobs. I think we need to have a labor policy that recognizes that worker power is a good thing, and that real investment that actually generates prosperity widely comes from a capitalist system in which both labor and capital have power and have to work together, not one in which we just make policy that we think is going to generate a lot of corporate profits, like the massive, incredible, extraordinary buybacks that we got after the Tax Cut and Jobs Act, and then worry sort of less secondarily about what we might get on the wage side later on. And I think we need to do family policy directly and recognize that we are not going to have a thriving, flourishing economy if we do not have greater family formation, greater family stability, higher fertility, and those kids being raised in situations where they are then in a position to contribute productively themselves. So I would love to hear a conservative agenda focused on all of that. Never hear the phrase tax cut again. I think fortunately we are in a world on the right of center where that is increasingly coming into focus. If you look at who the innovators, particularly in Congress, on public policy are, folks like J.D. Vance, Marco Rubio, Josh Hawley, the focus is not on let's do Reagan yet again. It is on what is actually wrong with the economy today and how we're going to fix it. And I think that is the path both to success for America and success for the conservative movement. Thank you.
Okay, so I do have some thoughts about where growth comes from. But first, I just want to sort of take a moment to think about where we are as a country in terms of growth. And I think this is a potentially very exciting moment and that we're really on the verge of something pretty amazing. I was just in Europe. And, you know, the growth outlook there is not nearly as rosy, sorry. And I think that's in part because this country has the most innovative and some of the most amazing companies that probably have ever existed and are really coming up with things that are truly extraordinary, that could really transform productivity and growth. We hear a lot about the downsides, but I think the upsides are incredible. I think there are some real dangers, though, if we can, I think, really sort of make that promise not fulfilled. And I think a lot of that is coming from, honestly, sort of disagreements within the conservative community about growth and where growth comes from, when really this isn't really as poorly understood, I think, as Oren suggests. I mean, although I think you'd agree with my first point, there's two things that concern me about the growth outlook that could imperil, I think, a lot of promise that we have right now. And one is the debt. I don't think really either side is very serious about reining in deficits. And I have a finance background, so I worry a lot about interest rates. I'm actually a retirement economist, so we worry a lot about interest rates. And I think there are reasons to think that we're heading into an era with higher interest rates, and that's going to put a lot of pressure on the economy. Right now, the latest CBO report shows we're spending more already on servicing our debt than we are on Medicare or defense. And if interest rates get higher, that's only going to get worse, and that is going to need to come from somewhere, tax increases, as you point out, and potentially less spending on the productive things that we do spend money on. And that means less capital going into more innovative features in the economy. And this is going to, and potentially, as I said, making capital more expensive for the private sector. So this potentially could derail our growth agenda. The other thing, though, that honestly deeply troubles me about is I think some confusion, again, about where growth comes from. I understand a lot of you are doing MBAs, or even if you're undergrads, might be taking some finance classes. So in finance, it's, there's just this one ironclad rule of finance that's always true and largely forgotten because no one wants it to be true, which is that higher returns come from taking more risk. It's just always that way. We'd like to forget it. It's a very seductive idea. You can't. This is why really smart people invest money with Bernie Madoff. They think, oh, I can invest and get a 7% return and no risk, and this is very attractive. That's why smart people fall for it, and I feel we're also falling for it in the realm of economic growth. Because economic growth also comes from risk-taking. It is just, you cannot get around it. I understand, I think we looked at China's growth rates over the last couple decades and thought, oh, gee, look, we can manage our way to growth. We can have 7% growth and never have a recession and have constant job growth if we just manage our economy right. But China was a special case largely because they were still catching up to our economy. But sustainable growth really comes from innovation. And unfortunately, innovation is a very inherently risky process. You don't know which innovations are going to work, and maybe they'll work, but there'll be no market for it. You don't know, maybe it won't work, or there'll be no market for it, but then it will lead to another innovation that will work. People forget the steam engine, which is responsible for the Industrial Revolution, took 150 years to show up in productivity statistics. It is a messy process, and we don't want to admit it, but unfortunately the market is the best one at figuring that out because innovation requires capital and you're having to invest in things that might not work and sometimes will grow too fast and then not, and it requires a lot of sort of reallocation within the economy, which means people lose jobs. It is not perfect. Risk has downside. And as I said, that's the price of growth in financial markets, and it's the growth in the price of growth in the broader economy. And I feel like we're losing sight of that. We see that certainly with the Democrats, with a lot of their Green New Deal. They're steering a lot of capital to the things they like, which is greening the economy, but that means less capital or a distortion for talent to go into fields that they wouldn't have otherwise. So it's sort of saying we want growth, but we want it on our terms. We want it to be in these sectors, but not those sectors. And it doesn't work that way. But conservatives are also largely being guilty of this too, sort of saying, well, these sectors are good, but I don't like these sectors. Or these people should have jobs, but these people we don't have to worry about. And it's just, you can't have it both ways. What really made this country so successful and made it the most dynamic market economy in the world were creating the foundations of growth. Sort of things like our bankruptcy law, sort of things like the corporation. All of these things really allowed risk to flourish. And I think we took a turn away from that, as you say, in the 70s for a lot of reasons. But I fear that it's only getting worse. There's different philosophies of why, but at least conservatives sort of always did favor the idea of rewarding risk. And I fear that now there's certainly an element that is less inclined to that. And also, sadly, risk also includes, well, I don't think it's sad actually, pursuing opportunities where they are and working with other countries. I think we've learned in the last couple of years how much people really hate inflation. Not only because it makes them poor, but it introduces a lot of uncertainty into their lives. And a lot of that, the reason we've gotten really used to having very low inflation for as long as we did is because we traded as much as we did. And that created an environment as well that sort of facilitated even more growth and more trade and a tremendous increase in quality of life. I think we minimize how much our quality of lives have improved since the 80s. We tend to sort of cherry pick various numbers, but there's no denying, I remember the 80s, most people didn't have air conditioning. It was awful. That means that, again, a turn away from trade, I look at it as another turn away from growth and from risk.
First, I got to say that I've known Oren for a really long time, and we really get along. And so when he, challenges things that I said 5 years ago or something with newer data, then it's a respectful thing that, is really something that you want to pay attention to. And when you disagree with somebody and you enjoy being around them, that's like the best possible thing. And so you might think, oh, Oren's just saying all this stuff about what Kevin said in 2018 and, how it should be changed. And I think that, he's pointing out interesting patterns in the macro data. And that's what debate is all about. That's why we have conferences like this, where we bring in, think about at Harvard how often they have conservative voices come, never, right? And I think that one of our challenges as conservatives is that we should also model disagreement in the way that it should take place. And so I'm grateful for Oren's remarks. And I don't want to debate the tax cuts right here. In fact, we were invited to this New York debate thing to debate the tax cuts, and I couldn't make it. And I think there's a time and a place for that. The one thing I want to say about just about that part of the presentation is that going back to the American Economic Association meetings where I made the presentation, right after you do something, then you can think about, well, why did I do it? And one of the reasons why we built the tax cuts the way we did was that there's this massive economic literature that's summarized by a paper that Glenn Hubbard and I wrote for something called the Handbook of Public Economics, which is the thing they use to teach PhD students public economics and tax theory. They're still teaching that paper over at Littauer, which I guess is that way maybe. And in that paper, we reviewed a massive amount of literature about the impact of tax reductions on corporate capital spending and found that everybody just about agreed the elasticity was about 1 or a 10% reduction in the cost of capital would increase investment by about 10%. And that was about the prediction when I was running the White House economic team that we made. And then the macro data came out, and they were just about, as you saw that first slide, right about 10%. It was right about in the range that the literature suggested. Now, the thing, though, is that when you do something, and then I'm going to go back to, because I want to address the bigger pictures here, but I just want to respond, collegially, partly to Oren's thing, and we'll continue the debate in the future. But one of the reasons why you look at macro data at the beginning is you don't have the micro data yet, right? So the micro data come out years later. And I've lived in Cambridge before and worked at the National Bureau of Economic Research down on Mass Ave, sort of halfway to Kenmore Square. And the NBER tax group, which you can go to their website and find, has been writing a whole bunch of really interesting papers about the Tax Cuts and Jobs Act with the benefit of way better data than I had at the AEA meeting when I'm just looking at the macro data, which, the problem with macro data, right, is there are a million other things changing. And so you could look at one macro thing and then maybe, okay, so anyway, but now there are randomized controlled experiments and all sorts of pseudo experiments and things that are being written by the very top people at Harvard and Princeton, Owen Zidar, Patrick Kennedy at Berkeley, and pretty much the consensus of that literature right now, the micro literature, but none of it's peer-reviewed yet, right? These are really hot off the presses NBR papers, is that the answer was about 10%. Once you control for everything else. But this is a debate that is not resolved, and so I'm the last person who would stand here and say, so therefore I'm right. In fact, one of the things I'm proudest of, and this is the last thing I'm going to say about taxes, and we're going to talk about where growth comes from, Because there's everybody, like when you have kids, you have to have that conversation with them at some point in their teen years, like where does growth come from, right? But the point is, one of my favorite things about my academic career is that my first peer-reviewed paper of the Journal of Public Economics, which is the top tax journal, said that the elasticity of the cost of capital, of investment, the cost of capital was really low. And then my second paper was it's actually really high. And I think that one of the things that is a metric of whether you're actually genuinely a scholar who's inquisitive is, do you have papers that report different results when they happen over time, or do you have 50 papers that say the same thing over and over? And I've got papers on both sides of the issue, and I think that in the end, that it'll probably resolve that the literature reviewed by Glenn and I that about predicted the right answer is what happened. And it looks like that's like what the early results are from the micro studies, but we'll see what happens after peer review. And there'll be other papers down the road. Now, the where does growth come from part, forget about, the economy is such an abstract thing. Think about just your own lives. So you've got a standard of living right now, you've got consumption that you do right now, and you want it to go up over time. That's what we desire for every American. At the Milken Institute now, I'm heading up a project on making sure the American dream is available to all Americans. And so the American dream is kind of like, I'm more prosperous in the future. So, but just forget about Americans and the economy. Think just about you. Now let's just say you want your consumption to be a lot higher 10 years from now than it is today, or your standard of living. How do you do that? Well, one thing you can do, and there are a lot of people in this room that have the perhaps mistaken belief that investing in human capital formation at Harvard is a good thing, but probably it is. But you can make your human capital go up, and that your wage will hopefully go up if markets are competitive. And so if you invest in your human capital today, then you'll have more human capital in the future. Your wage should be higher. You could have a higher standard of living. So where does growth come from? Well, for you, your standard of living goes up if you invest in your human capital. But the other thing you could do, I went to a restaurant last night with my kid who lives in town, and that was money I spent. If I didn't go to the restaurant and I put the money in the bank, and then I stopped going to restaurants this year and just kept putting money in the bank, then I would have financial capital in the future that I wouldn't have otherwise had. And then that financial capital of the future could finance a higher standard of living. So I could have a higher standard of living because I invested in human capital. I could have a higher standard of living because I acquired physical capital. And then there's one other thing that could happen, and it's happening right now. It's the story of the economy right now. It's so exciting. And that is that you could show up at work, and then some random technological change, like, say, artificial intelligence, makes it so that you're radically more productive, and so your wage goes up. But that's what we call total factor productivity. But you could get growth because of technological change that just could happen because some really brilliant person thought of something that we didn't think of, and it makes us all more productive. You could have growth because of human capital formation. You could have growth because of physical capital formation. And that's it. That's pretty much where growth comes from. And so when we're looking at an agenda that will, support human flourishing, then we have to ask ourselves, so how do we make each of those three things go up? And I think that if we focus on the question that way, then we'll naturally debate each of the three things. But that's where growth comes from. And then you can sort of say, well, what do conservatives believe? And I actually don't like that question because I think, like, if you say, well, do you believe someone's innocent? Then, well, they might be guilty. And I think that as a conservative, there are things that, Oren and I disagree about stuff, but there are things that we as conservatives know. And that is a just society is a free society, and a free society is one that has free enterprise. And so when we're thinking about those three things, then we want to pursue a just society, a free society that empowers free enterprise. And we can do that perhaps, or for sure, by focusing more on the family than we have, because that's human capital formation. And so we could go down the line. But I think that that's where growth comes from, and I think that that's what I think the headline for me is what conservatives believe about growth. Thank you.
Well, thank you all. We have a couple questions, but I invite members of the audience, if you have any interest in asking a question, please put that into the Q&A by scanning the QR code on your table, scrolling down to the bottom, and clicking on the link, and then asking a question. But I'm going to ask a couple questions just generally about different economic policy adjacent areas that might be contributing to our lack of growth, or rather that might allow us to have more growth. And I guess the first question was, Oren, you talked a little bit about, this is for all the panelists, but Oren, you talked a little bit about competition policy and monopolies and that's role on growth. Obviously, our current FTC chairwoman, Lina Khan, believes that monopolies have inhibited growth in America and are actively limiting our economic potential. So my question for the panelists is, do you agree with Lina Khan's philosophy on monopoly, or do you disagree, or if somewhere in between, elaborate?
Well, I guess one thing I'd say is an interesting question whether her analysis is focused on growth at all. And I think it's important also for conservatives to recognize that growth is only one element of the constellation of things we need economic policy to consider. So, you know, I think in a lot of cases on the competition front, for instance, that there's a question of how economic power translates to political power, and how in the free society that Kevin was describing, we do or don't have to be concerned about particular concentrations of private power as well. That being said, in the context of growth, what I would say, and you know, I think the AI example is a great one to focus on here, because it's really important to understand. I agree with everything they said about the role that innovation and total factor productivity plays in growth. My question would be, well, how well do we understand what drives innovation? And then what is it that causes that innovation to diffuse in ways that actually do drive the growth that we want and that do accrue to broad-based prosperity? And so I think it's absolutely the case that what we're seeing with AI and just technological progress generally has the potential to redound broadly to Americans in the form of economic growth. It's also important to say that that will not necessarily happen. And that point, you know, sort of case study number one in this that I'm fascinated by and frankly don't understand, but it is what the data shows, is that productivity in our manufacturing sector has been declining for a decade. Not growth has been slowing. It actually takes more labor in an American factory today to make the same things you would make in an American factory a decade ago. So all of the things you're hearing about automation and robotics and we've seen the robots. That is not actually translating to a domestic manufacturing sector in which workers are more productive, able to earn a higher wage, and American manufacturers are able to be more competitive globally. The AI context, I think, raises a parallel question. Yes, absolutely. Could you imagine AI diffusing throughout society, being applied to workers in their jobs in a way that makes firms more productive, in ways that makes workers more productive, in ways that drives growth and prosperity? Yes. Could you also envision a world in which a couple of very large firms that have the capital investment to build the necessary data centers and corner the market on the necessary chips end up with a stranglehold on the most advanced AI systems and find that, remember, they don't care about growth. They care about maximizing profitability. Find that the strategy that maximizes their profitability is not one that diffuses technology in that way. I don't know that that's going to happen. I find myself a little bit in the position of Congressman Crenshaw and Professor Ruger sort of debating counterfactuals even before we get to them. But my point is that that is the way to do the analysis and the question to ask. And that's why the work someone like Lina Khan is doing at the FTC and raising that as an issue that we actually need to acknowledge and worry about is so important. Because the conservative dogma since the 1980s, I mean, on antitrust in particular, has been we don't need antitrust at all, markets are efficient, and as long as consumers are benefiting, none of this other stuff matters. And the reality is that this stuff all matters a lot, and good economic policy has to take it seriously and not just trust that through an invisible hand, the process of innovation and growth will simply spring forth.
Yeah, I mean, I'm in broad agreement that, you know, at this point we're really debating counterfactuals. I don't think there's a lot of evidence that market concentration has been a big drag on growth. I mean, I think there is something to consumer welfare still, and the fact is that prices have gone down a lot. and up until recently, but that wasn't because of market concentration. So it's hard to argue that the consumer is getting squeezed. In fact, I think Amazon, one of the countries that is in our crosshairs, has actually, there's evidence lowered prices, and that's been better for consumers, and in some ways better for competition, because I think, it's definitely a concern, and I think we should definitely keep an eye on it, because, market concentration does increase a lot of risks, and there is potential for abuse and less competition. But I think we should also be mindful that markets change, and the right market structure also changes. And in a tech economy, particularly more global economy, there becomes much bigger returns to scale. And if that's the case, then, if we make our big tech firms smaller, then that just means another country's tech firms have an advantage. And it could also just mean that instead of little companies growing into big companies, it makes more sense for little companies to grow a bit and then get acquired by big companies who have more capital to grow them even bigger and make them more efficient faster. And I think even with Amazon, we do see smaller retailers getting access to larger markets, which in some ways does make them better. I mean, there is an anti-competitive story, but there's also a very pro-competitive story. So as I was saying earlier, like our big tech firms right now are saving grace. Like the stock market would be down if it wasn't for them. And they do a lot of things that do make our lives better. It doesn't mean that we shouldn't be mindful and be keeping an eye on them, but we shouldn't necessarily jump to the conclusion that big is bad. Because as I said, markets change and so does the right structure. And also, I think we should also be mindful that, for a lot of the 20th century, a couple big firms dominated the economy too, were really a big share of the stock market. And those big firms, some of them aren't even on the S&P 500 anymore. And that wasn't necessarily because of antitrust policy. That's just because of the way markets work.
Oh, thanks. Yeah, I'll actually reference two of my colleagues at Stanford. One of them, a fellow named Mordecai Kurtz, who was Ken Arrow's co-author for A Million Things, and Mordecai is still around and doing amazing work, has written at Project Syndicate a lot about whether there's increasing concentration in the US and increasing monopoly profits. And he has a lot of thought-provoking evidence that there is increasing concentration and increasing monopoly profits. It sure doesn't mean that I would support anything like what's going on at the Federal Trade Commission right now, but it's like an important thing. It's an important food for thought. And then I'm going down the Mordecai avenue just for a second. The interesting thing about tax theory, the kind that they teach over there at Litauer, is that one of the things when I at Columbia taught it, that one of the things that is true, and this plays into the kind of arguments that Oren's been making, is that if you tax a pure rent, saying it in economistese first, then it doesn't have an effect. And the way to think about that is, suppose that we took LeBron James and told him, we're going to tax your wages by 20% more. Would he still try just as hard to win the NBA championship? Yes, he would. And to the extent that you think that pure rents are skyrocketing, then it does actually provide a challenge to people who are like super concerned about like capital taxation and optimal taxation, because a tax on rents is like a different thing than a tax on or just things that go into our normal cost of capital formulas. And so to take the LeBron James example, and this is not a policy proposal, but really like meant to be a stimulation for thought. Suppose that we just said to Microsoft, hey, you got lots of pure rents. We've come up with this formula that says it's pure rents, and so we're going to lift your tax rate by 5% or something. That would have a much smaller effect, I hypothesize, on what Microsoft does than if we were to lift the corporate tax rate for everybody, including firms that are out there competing. And every little margin matters. And so I think thing one is that I think that it is true that pure rents seem like that they're starting to accumulate at a few big firms, and that's like a challenge to traditional like right and left thinking about optimal tax policy. And then the second colleague at Stanford, I'll mention just really briefly, is Eric Brynjolfsson, who was at MIT, and we fortunately were able to steal him out at Stanford, is I think the economist who's done the most amazing work on the diffusion, both of like back when it was the internet and the first thing that he worked on, and now AI. And I commend to everyone an interview of Eric in the Financial Times, and sorry it's behind a paywall, but he was just like so we're talking about like it's all counterfactuals and like speculation, but actually there's a huge amount of evidence accumulating about the impact of AI so far. And the impact of AI so far is like profoundly impressive in terms of things like productivity. And Eric has a few papers where he talks about that. But and this is the last thing, because I definitely hope we have time for a few more questions. But in the FT interview, Eric summarizes what he's thinking, and for me, he's the person I trust the most on these issues. He spent his life thinking about it. That he thinks that over the next 5 years or so, that total factor productivity growth, that all of a sudden I'm more productive, that it'll probably average around 2% a year, because of the productivity gains he's seeing in the data right now from AI. And if that happens, it's just like a fundamental game changer in terms of the way we think about the economy and the world that we live in. Thank you.
Oh, all right, I'll use both microphones to make it extra loud. I just want to pick up on something that Allison said about the sort of the big tech companies, because I think it goes well to sort of this divergence we're seeing in conservative thinking on this right now. It has been traditional to use a stock market chart as an indicator of how well we are doing as an economy. And I think it's really important to notice that that doesn't tell you anything about growth, especially in the context when, as you described, you have these 7 companies that are responsible for all of the stock market growth. That is not an indicator of a healthy economy, an innovative economy, a growing economy. And when you start zooming in on those firms and you ask, wow, why is a Google or a Facebook so valuable right now? Is it because they're wildly innovative? Or is it because they're sucking huge monopoly rents out of the out of advertising? By the way, well, not where their profits are coming from. And let's keep in mind, by the way, which firm is leading in AI and had the first breakthroughs there. It's one controlled by a nonprofit board. So you have Google and Facebook doing what they're doing. It's also important to keep in mind Tesla, one of those big 7. How did Tesla get that valuation? Well, it's actually by offshoring their production and becoming, in essence, a Chinese company, right? Their largest manufacturing facilities are now in China. Their highest potential market is in China, to the point where Elon Musk has now committed to something about endorsing socialist principles. Their stakeholder report says most of their key stakeholders are in China. There are lots and lots of ways to generate very high returns for shareholders in the US. And by the way, half of publicly traded equity on US markets is now held by foreigners, without actually generating economic growth in the US, let alone broad-based prosperity in the US. And so those are exactly the sort of things I think a renewed focus on competition policy, not from a consumer welfare standard, but from a structure of the economy perspective, is super important.
Do you have something? Do you want? So I guess as a follow-up question, just you mentioned Tesla offshoring manufacturing to China. This question for the panel. It seems like increasingly from both the Trump camp as well as the Biden administration, there's this growing focus on manufacturing in the United States. So if the 80s were about focusing on cutting taxes, the 90s and 2000s were focused on globalization as an economic policy, it seems like now both parties, to some extent, are focused on bringing back manufacturing. And that seems to be their focus on how to spur economic growth. So my question for the panel is, do you think that this focus is correctly placed? Should we be intervening in the market to support a manufacturing sector? If yes, why? If no, why?
Can I go first on this? Yeah, I was in the middle of this, right? And I'm the globalist person in the Trump White House, right? So I can remember I'm sitting in Gary Cohn's office right at the beginning, and there are a lot of, the congressman mentioned, once you get a top secret clearance and you start to see everything that's going on, you start to get pretty upset about like how at risk we are. And the China threat is a really serious thing. It's something the previous panel, they know way more about it than me. But the point was just that we started to list the things that we wouldn't have in the US if China decided to shut off the spigot. And one of the things that we wouldn't have in the US, except for we bring them from China, is antibiotics. I'm serious. And like, so we had a list, and we had the trade people tell us, like, and so I'm a free market guy for sure, but the point is that in a geopolitical game where somebody might just get mad at you and stop trading with you, then if they're a potential enemy and they own a lot of the stuff that's crucial for the survival of your economy, then you're at risk. And a lot of those things were identified back in the previous administration, and with a lot of very careful work by Bob Lighthizer and so on. And then, tariffs were put on China with an eye towards things that we need to onshore. And now President Biden has subsidized things as well. And I don't think the government should be picking winners and losers, but we should definitely speculate about losses we might bear if there were a conflict. And that's something that the free market couldn't possibly do.
So, I agree. I think we shouldn't depend on any one country for manufacturing, be it us or China. We should definitely adhere to the principle of diversification, and particularly if prices aren't really market prices because there's manipulation from another country's coming through, then, it's hard to say, let's just let the market do the work. But I think, I'm definitely more inclined toward markets when it comes to manufacturing, but not entirely, because I think there's a big role, as Kevin pointed out, in human capital. And I think the future of manufacturing, is changing. It is becoming much more highly skilled, a lot more technical. And so we also need to make sure that we have a labor force that can be competitive in that, because, for a long time it was very easy for manufacturing jobs to go abroad because, well, labor was a lot cheaper there. An aging population in a lot of countries we've been relying on, that might not be true anymore. So some of that comparative advantage might come back here, but we need to have the skills to meet that. So I wouldn't say we want to start subsidizing manufacturing per se, but we certainly do want to get more serious about promoting human capital formation and training a labor force that can be competitive and, as I said, participate in the manufacturing global economy that way.
Well, I mostly agree with all of that. I think I particularly like the point that Allison made about, is it a free market if the other side is messing with the prices? And I think it's just really important to sort of take that thought to its logical conclusion, which is that we've always taken free markets and free trade to sort of be almost synonymous, right? Well, if you're for free markets, you're for free trade. And it's important to recognize that in a really important way, at least in today's economy, those two things are actually antithetical to each other. If your main trading partner, the 800-pound gorilla in the global tradable goods economy, is going to be an authoritarian, communist, state-owned economy, then you have a very important choice to make whether you want to integrate your market with theirs or not. We made a choice in 2000. Yes, we were going to integrate markets. And by the way, we were going to transform them into a liberal democracy in the process, A+. But if you don't, if that whole we're going to transform them into a liberal democracy doesn't work, what are you left with? You can profess to be a free market and believe in free market principles, but everybody who's actually competing in your market now has to care about what the Chinese Communist Party thinks and does. And that is going to affect capital allocations. That is going to affect whether you invest at all. That is going to affect terms and conditions that workers see. That's going to affect what careers people pursue. And we're now sort of realizing, well, wait a minute, we've lost all these things. We need to get some of them back. But it would be worth going back and thinking, well, how did we lose them, right? And how do we make sure we don't just keep losing them and lose the next set of stuff? And there's a trade-off here, which I will absolutely confess is a painful one. I mean, to Allison's point, one thing that worked great with this deal is cheap stuff, right? Like, hey, China sent us cheap stuff, thumbs up. The reality, though, is that what we sent back and what made it so cheap is we sent back IOUs, right? We let them decide what they wanted to make, subsidize it, hollow that out of our economy, and then rather than buy something else from us instead, which is how trade is supposed to work, we sent back assets. We sent back either ownership of things here in the American economy, claims on our future prosperity, or pieces of paper saying we will pay you for this later. That's how trade works if it's not actually balanced trade. And so something can simultaneously be good for consumers. It can even look good in the short run in the economic growth tables. And yet it can be very, very bad for your actual trajectory of economic growth in the long run. And by the way, if you go back to the pre-World War II economics textbooks, all the economists knew this too. And so I think it's important to say trade can be mutually beneficial. We want to do it when we can, but the default, well, but our economics tells us trade is good and that's where we have to start, is just not true in this economy. And I think policymakers are seeing that now, and it's very important that conservatives recognize it as well.
Add a couple of points of fact. I'm sorry, applause for Oren. Don't applause. No, no.
What's the deadline, please, class?
I just wanted to add a couple of points of fact just in this space and to highlight the point. One of the things that the previous administration did super aggressively because of misconduct was completely crack down on anybody's trade with Iran. And it starved Iran of money. And I think it had a positive effect on the global economy, but it wasn't free trade. And so as soon as you're in that space, then the sort of trade model is not the only thing that one needs to consult. But then I just had a point of fact, which is that this really aggressive policy started the previous administration, maintained in the current administration towards China, has had a big effect, just like the effect of the previous administration on Iran had a big effect. And so it just turns out that it just happened that Mexico is now our leading trade partner, not China. And the Chinese economy is on the ropes. Go read the financial press and see what's going on in the Chinese economy. And so these aggressive actions are regrettable in the sense that we wish it didn't have to be, but they've been effective.
Thanks, Trevor. We'll go ahead and move into audience questions. First, we'll start off with one from Anonymous. Is growth good for its own sake or only insofar as it serves other goods? Or in other words, are there policy objectives, for example, healthy families, more important than growth?
You don't have to.
Well, I mean, growth is really important for rising living standards, for living longer, and honestly for making families healthier. Because, healthy families are, more prosperous families do tend to be healthier, and it improves household formation, all of these wonderful things. So I don't think a good way to think about it, healthy families, intact families, super important, obviously. But I don't think that's at odds with growth. I don't think we have to say, well, we care about this more than growth. I think that they go together. And I think we find, if there's one thing we know, that political instability comes often in countries that are not growing. So that's generally when countries fell apart, and that's when you have social instability, which is bad for pretty much everything. So growth is, as I said, really fundamental to sort of the solution to a lot of our problems and for future prosperity. And I mean, it's not, it's hard to pick one goal, but it's not a bad one.
I guess I would say it's really important to ask what kind of growth. That growth can be compatible with the other things we care about. And I think ultimately we need to think about as a means to some of those ends of human flourishing. The problem is that left sort of to its own devices, the free market is not necessarily the friend of the family. The free market does a lot of things that are very corrosive of family and community stability. And I think just take an obvious example, if we said, like, it's just, well, growth is good and growth will support families, what we saw with the model of globalization was, you will have heard this phrase, yes, it will create winners and losers, but the winners can compensate the losers, right? We said there's a formula here for maximizing growth, that we don't worry who benefits from the growth, as long as we get the growth, and then we can redistribute to whoever was left behind. Now everyone has more stuff, and like, A+ yet again. We're killing it across the board. And it's important to recognize that did not work, and that does not work, and that if you pursue that model of growth, you will in fact actually destroy an awful lot of communities and the basic foundations of stable families and the environments in which a next generation is going to grow up. And as the real kick in the pants at the end, the Wall Street Journal editorial board and the Heritage Foundation will then come around and say, no, you can't give anything to the losers, that's redistribution and welfare. So it's really important actually to keep in mind that good growth absolutely supports those things, but growth doesn't automatically support those things. And in fact, I think it's a lot more constructive to think about it the other way around. And this goes back to my question of how well do we really know where growth comes from? It seems to me that an environment that actually supports flourishing families and communities is the one that's going to generate the growth at the end of the day. And if you do things that sacrifice that for the sake of the GDP number next year, you're going to end up in a much worse place and that ever declining growth decade by decade that I put up there.
Sorry to reach in front of you. You know, I think that there are two factors to consider here. Factor one is if you look at all the promises our government has made, then the only way we could possibly keep them, get the revenue to keep them, is if we get a heck of a lot of growth. And so at the macro level, in terms of like the US, if we have 1% growth versus 4% growth, it has a huge impact on our ability to keep our promises. And if you think about what happens if we don't keep our promises to the seniors who suddenly aren't getting their Social Security checks and so on, it's a catastrophe. And so growth is urgent and should be the focus of policy analysis. At the same time, there are about 15 million people in America that live in communities that have had a poverty rate higher than 20% for at least 30 years. Think about that. And so suppose that we're really successful at delivering growth and we get the growth we need so that we're sure that Social Security is going to be okay and all that kind of stuff, and we don't change those communities, then I think we will have failed. Part of our job as policy designers is to think about like everybody in America, but especially the people at the bottom. Like if you believe in the declining marginal utility of consumption, then the people who have low consumption should be the most important focus of public policy. And that's why Jared Bernstein, who's now the chairman of the Council of Economic Advisors for President Biden, and I wrote the paper that invented opportunity zones. And the opportunity zone, again, the idea is to create a tax incentive for capital to move to these distressed communities. And it was motivated by the first thing that we talked about: where does growth really come from? And if I want those communities to grow, then I've got to like help them get better human capital acquisition, and I have to help get physical and financial capital there. And one way to do it was with opportunity zones. And so I think the growth question was a great one. Because it gave us the opportunity to highlight, both like the big picture target, which is the kind of thing that you often see supply-siders debate with other people, but also the limit of focusing only on that macro issue.
Well, thank you all. Before we thank our panelists, I just want to note we're going to move right into our closing remarks. So everyone just please, there's no break, just please stay seated. We're going to move into closings. But I would like to thank you all for a fantastic panel. And thank you so much for taking the time to come all the way up to Boston.
Thank you.